Hi everyone. Quick intro. I'm a 38-year-old Singaporean working in tech, and I've been a growth investor in US stocks over the last 4 years. I've recently renamed this channel to the ContraTurtle Show. The aim is to show you contrarian ways of making money through the stock market that is different compared to the usual condo flipping game that most Singaporeans play. Now, I'll share my thoughts on investing and finance as a Singaporean 9-to-5 worker living in Singapore. So all portfolio denominations will now be in SGD. In today's episode, I'll share transparently my plans to turn my 410k portfolio into 4.5 million SGD in 12 years' time. So for those of you who followed me over the last year or so, you'll know that I spread my investments over 3 brokers, namely Tiger, Momo, and IBKR. And you also know that I run a really concentrated portfolio that's mainly in the tech and e-commerce industry that falls within my circle of competence, having worked in tech over the last 6 to 7 years as an engineer. I won't go into details of the individual portfolio selections, but you can take a look at my past videos where I break down my thesis for each company. So you might be wondering, why $4.5 million? To get to this number, I began by considering how much money I want my stock portfolio to passively generate per month, assuming I don't work at all at the age of 50 years old. So I think 50 to begin with is a reasonable age for me, still young enough to enjoy life with good health. And also there is a long enough time of 12 years for me to slowly work towards this goal. And I arrived at 15k, which I know is a very high target, but it's a number that I truly believe is possible to plan for over 12 years, which can adequately cover my family's basic expenses such as household stuff, transport and food. I want it to be a number where I don't have to stress over budgets while my family eats at restaurants. Of course, I don't mean like Michelin star restaurants every day, but maybe once in a while is okay. And just eating out in general, there shouldn't be any issues. So I want it to be a truly stress-free lifestyle where budget is the least of my concerns. And I also think this number will allow me to fulfill my dream of traveling with my family 2 to 3 times per year, especially to Japan, where I have a dream of covering all 47 prefectures and also to master the Japanese language. It's important to note that in my calculations, my HDB flat that I currently stay in would be fully paid by then. I don't even need a car. Even if I do, it will be a very basic Japanese car to keep my expenses low so that I don't have high overheads even with this 15k monthly budget. And so now with this 15k in mind, we work upwards by multiplying 15k by 12 months, and that gives 180k Sing per year. Then I take 180k and I multiply it by 25 in alignment with the very commonly used 4% consumption rule. When consuming a stock portfolio for passive income, there are really 2 ways that I intend to do this. I'm still planning. The first is by divesting the growth portfolio of US stocks that I currently hold at 50 years old, and then simply investing the $4.5 million in proceeds into local dividend paying stocks such as DBS, UOB, etc. that have a historical yield of about 4 to 5% per year. So taking the lower and more conservative 4%, theoretically I can consume just the yearly dividends without touching the underlying 4.5 million capital. And the pros of this are that this is obviously less volatile. We won't be subject to USA's 40% estate tax. There are no dividend taxes, but of course there is less explosive long-term growth compared to owning more global companies like USA stocks. The second option is to simply keep the growth portfolio intact. This is a bit of a contrarian way of doing this, but it is possible. I have friends who actually do this and they intend to do this as they get older. And so they let the growth portfolio continue compounding. But every year on average, I will consume 4% of the portfolio by selling shares. And this is of course more volatile and it requires more mental exercise and planning where I need to withdraw more on good years and less in bad years to minimize any impact on the compounding effect. So there's a lot of budgeting work that goes on in the middle. Now the good thing about this option is that the portfolio will grow far more than a dividend portfolio in terms of total return. Now, I'm still not 100% sure which path I will take if I hit my 4.5 million target at 50. But I think it boils down to my mental sharpness at 50 years old, because following developments in the tech scene and studying these businesses requires a lot of time commitment and is quite intense. For example, I subscribe to about 3 to 4 different services. I read a ton of articles every day. I watch a lot of YouTube videos to keep up to date on technology and companies in my portfolio. I ask a lot of my tech colleagues at work questions, my mentors questions on what's actually going on, the underlying technologies and the trends. And so the next factor is also my interest at that point in time at 50. You see, people change with age. I don't know what kind of person I'll be in 12 years' time. I might want to spend more time with my kid. I might become less interested in the tech industry. Maybe I won't be able to follow it as intensely as I do now. And lastly, I could be just simply far less ambitious and maybe more risk averse at 50 years old. I want to take on less volatility. So I might just want to chill and not care about the markets anymore. Just sit on simple dividend paying stocks and just go on my holidays or just, relax. I don't know. So let's see at that point. But at the very least, I have both plans granularly laid out 12 years in advance. And I know, what I need to do when that time comes. So now let's talk about how I intend to hit 4.5 million by 50. Again, we have to work backwards and ask with a starting amount of 410k Sing and an ending amount of 4.5 million and a duration of 12 years. Firstly, how much money can I reasonably invest per month, which is your contribution rate? And secondly, what return do I need per year over 12 years to arrive at my destination? Now, using an investment calculator at calculator.net, this is all free. I plugged in all the figures. The additional contribution I put in is 60k, which is how much of my salary and all whatever bonuses I get that I intend to put in totality per year. Now, I want to take a quick pause here because I know there's a thought creeping into your mind now. Are you a high income earner? Of course, can contribute 60k per year lah, 5k per month eh. Guys, don't fall into this mental trap and give up like this. These things don't happen overnight. I want to share with you my journey, how I got here, the decisions I've made to make these plans possible, right? Firstly, I live in a simple BTO HDB that I applied for 6 to 7 years ago with my wife. So that tells you, very frankly, the rough household salary bracket I was in 6 to 7 years ago, right? Over the last 7 years, I worked really hard, pivoting my career from events industry to technology by self-learning programming through online courses because I didn't have a computer science degree. So I didn't start investing 60k per year at the start, no, right? I was a much lower income earner. It was way lower back then, my contribution rate, right? But what I've done over the years is to really keep working hard. You have to increase your skill sets to increase your income so that you can prove your value. And more importantly, guys, this is the most important point. As your income grows, don't play that Singaporean game of buying branded stuff, inflating your lifestyle, buying the BMW. I know some of you go and see Zentik or Kor on TikTok, all this stuff. I think he's an insurance agent. He every time he hits a milestone, he buys a BM. And then I hear like there are some influencers. No offense, right? Maybe they earn far more and the expenses are, a very small percentage of what they earn in terms of their businesses and their social media and stuff and their insurance selling, right? But for most Singaporeans like you and me, I'm just a regular worker. I don't have any businesses. I'm not talented. I've tried so many businesses and I failed. And so I just decided to do this very simple route of doing the investing game, focusing on investing, not inflating my lifestyle. Don't play that game of the status game and keeping up with the Jonases and your neighbors and your cousins or whatever to show off to them every Chinese New Year. Don't do that, guys. Okay? Think about the long game. Right? Defer your gratification. Delay your gratification. Right? So, for me, for example, I haven't bought a car, right? Even though I've improved my income power. Nor have I bought any luxury goods or whatever, branded clothes. I don't believe in that. Or expensive toys like Labubus, which is like the rage now. I don't know why. Some people say it's for resale value and stuff, but I don't buy that. I don't buy that narrative. I think it's really just showing off on social media. Nor do I play the condo chasing game, which is a huge part because the moment you make a decision to just chase after buying a property, if I quote Mr. Lu of 1M65, which is another YouTuber in Singapore, Mr. Lu always says buying a property is a KKK asset, Kong Ka Kiao. Why? Because if I talk about it very bluntly in a very contrarian way, well, not very contrarian, it is quite matter of fact. if you are playing the condo chasing game, you're paying high mortgage every month. You have far less money left to invest for your future. What you're really pinning your hopes on is that, in some X time in the future, you will then sell your supposed condo and flip it, and then you downgrade to a HDB. And then with the balance, you can use it for your retirement. That's like the most common retirement plan. But there are so many question marks about this, right? Firstly, are you really, after so many years of living in a condo, able to so-called downgrade on a pride and face value status in Singapore to a HDB? Well, maybe you might, but my second question to you is, after you get a sum of money, then what? What's your plan to generate passive income, right? So anyway, I don't want to get into this. This is really contentious. I'm going to open a Pandora's box. I'm probably going to get some comments about this. I probably can leave this to another episode to talk deeper about comparing condos and stock investment. But the point is that the reason why Mr. Lu said it's a KKK asset, KQQ, is because the value of your property is only realized when you sell it. And the problem is that most Singaporeans are treating the condo as homestay, which means you're staying in that condo. So the value of your asset isn't realized until you sell the very place you're living in. Then my question is, after you sell it, you still need to buy another property to stay in. So for me personally, I don't mix the two. I sort of treat the home as an expense. And then whatever remainder I have in my income, I use it as investments. So that when I reach a certain age that I want to retire at, I then retire on an investment portfolio and do whatever I want to do with freedom, right? So this is just a very different game I'm playing. I'm just giving you an alternative, right? And also one other point, back to the whole thing about, Rome wasn't built in a day, right, guys? Don't give up so easily, right? You're going to say, high earning and all that stuff. I'm already 38 years old, right? If you look at my current age, I would say, in fact, I'm a bit of a late bloomer. I pretty much wasted most of my time in my 20s, not being serious with my life, overspending whatever income I got. I learned my lesson very late. Don't make the same mistakes I did, especially if you're teens. Very good for you. You're educating yourself and going to get better in the future by investing and not playing the keeping up the Joneses game. So I don't want to spend any more time on this episode on career and motivations, but all I want to tell you is don't fall into the mental trap of just giving up in terms of your contributions, right? Because apart from contributions, you can tweak a lot of parameters in the red box. You can shift the time horizon for longer than 12 years, especially if you're younger, so that your monthly contributions can be adjusted. You can aim for a lower end target amount as long as it fits your lifestyle habits that you think you can enjoy when you're older. The most important thing I want to point out is that we arrive at a CAGR, which is a compound annual growth rate of about 16.5%, which is how much my investments need to perform every year to hit this 4.5 million goal by 50 years old, while maintaining a constant contribution rate of 60k per annum, assuming my income growth just stays stagnant over the next 12 years conservatively. So now the question is, how do I get 16.5% CAGR, right? When I first started investing in the stock market about 4 to 5 years ago, the most popular idea was to invest in a broad diversified ETF like the S&P 500. So I prefer to look at annualized rolling returns for a more conservative gauge. And what I found was that the S&P 500 returned about 8% median rate of return per annum on a 15-year rolling basis. This means that the S&P is not able to achieve my target of 4.5 million by the time I turn 50, because I'm a late starter, right? I'm a late bloomer. Because 8% is half the 15 to 16% annual rate I need given my slightly shorter time horizon. Right, I say shorter, but it's still over a decade, right? So that really just shows you the importance of how long you really need to accomplish some of these things. Next, I looked at the next popular ETF, which is the QQQ Nasdaq. And that too yields about 12% on a median rate per annum over a 15-year rolling period. So when I began investing about 4 to 5 years back, I actually started with the QQQ. I invested in it because I understand a lot of the companies in the index. I understand how USA businesses work because I frankly work in a North American company in tech. So given that I work in tech by trade, I felt that this was an advantage I had in assessing the state of the market and technology trends. So the QQQ was perfect for me for an ETF. But again, when I seriously began planning for retirement about a year or two into investing in the QQQ, I realized that the 12% wasn't going to make the cut. And this is why a few years ago, I made the decision to raise the risk profile of my investments by divesting all my QQQ proceeds into individual stock picking in order to try to beat the market. Now, I won't get into the specifics of my investing process. You can click on this video. It should be appearing at the corner right now. Hopefully I get this YouTube stuff right, where I talk about my 8-step stock selection criteria. And so where am I today? At the time of this recording, obviously the market is super red, but this is exactly the time to be transparent with you, where I sit in portfolio in my portfolio in the current market conditions, right? So over the last 4 to 5 years, the ContraTurtle fund has performed at about 15.7%, which coincidentally keeps very close to the 16% I'm aiming for. And this is in spite, obviously, of the biggest one-day drop in the market that just happened on Friday and the very red conditions that have ensued over the last 1 to 2 weeks, right, since all the tariff plans that were announced by Trump. It's also important to realize that you should never assume you can sustain high returns per annum over more than a decade. If you look at this simple chart of the world's top investors, even Jim Simmons of the Medallion Fund, he had an army of PhD mathematicians. He managed to do 39% over a 30-year period, right? Even with all these math geniuses. And he himself was a PhD genius. And even the legend, Peter Lynch, who wrote the book One Up on Wall Street, right? He ran the Magellan Fund, huge successful fund, probably the most successful in history. Given the so-called short tenure of 13 years, he averaged 29% CAGR. So I personally prefer to look at Buffett's return. Over 53 years, he did 21%. I think is a very good yardstick to say, hey, look, there's no way I can beat Buffett. I know I can't beat Buffett because he is simply the greatest investor for the longest period of time. So I look at my targeted return of 16% and I ask myself, is this possible? Yes, I think it's reasonable for 16% because I'm definitely not as good as Buffett, but I believe I can eke out 3 to 4% slightly better returns than the QQQ by focusing on stocks within my circle of competence, which is in tech, and being contrarian and buying them during times of pessimism like today, and holding them through for the long term instead of trading in and out of the market. In fact, a 16% return on capital when compounded over 12 years is still a very impressive 6x return on capital. So never underestimate the compounding effects on investing in strong businesses with sustainable moats over a long-term horizon. I hope you enjoyed this episode, everyone. Thanks for watching and have a good day.